Hello, good evening.
Good evening, Professor Hung. How are
Yeah,
you?
hi, good. How are you? I'm
I'm
good.
okay,
Good evening,
thank you.
Imani. Well, this is quite disappointing. I mean, it's only 6:02, so I guess we'll still need to give a few more minutes. But only one person in the collaborate, actually, and two people in the discussion board, right? Oh, actually, we're getting more. Um, So I'm hoping, these people will join us in the collaborate soon. Uh, you can go and go to the today's forum and nudge them, right? But well, anyway, so just to bring you uh, just to bring you up to speed. Um, so in our last class, we were just starting on the free cash flow model, right? Which is the fourth uh, fourth model, right?
hmm
And free cash flow model, I said, is quite uh, comes in quite handy, and it's crucial because not all the companies pay dividends, and if the companies don't pay out dividends, we cannot use dividend discount model. Well, in that, then what do? We'll have to use the free cash flow. So instead of dividend, but basically the math is the same. It's just instead of the dividend, we'll have to use free cash flow. And if you remember, right? So the free cash flow, yeah. So let me delete this and start a new one. Uh, Now think about it. EAT, I mean, in dividend discount model, right? Yeah, that's not the color I want. In dividend discount model, right? Uh, Dividend is basically EAT, or times dividend payout ratio, right? Dividend discount model. Whereas, in free cash flow model, and we all understand that the EAT is the result of, um, which is net profit, right? Uh, from EBIT, you pay out. It's a pain. It's a real pain to. Okay, my elbow is hurting. You'll have to pay out interest, and this thing jitters. It's not. You pay out interest and then pay out taxes. God, I need to. It's too close. From EBIT, you have to pay out interest, and then you'll have to pay out taxes, and then finally you arrive at EAT, right? Okay. Then think about it. In free cash flow model, so I have to move this up. In free cash flow model, free cash flow is operating cash flow. Operating cash flow minus investment in operating capital, right? Where our operating cash flow is EBIT minus taxes plus depreciation. So think about it. And then minus, from that, we subtract. We'll have to subtract investment in operating capital, right? Okay, so now if you think about it then, that's where they separate. I mean, dividend and free cash flow. Free cash flow is, of course, much bigger, right? Much bigger a number, a much bigger concept than just the dividend, right? Because from EBIT, they separate, right? From, why is it? Okay. See, from EBIT, right? But after subtracting interest and taxes, we arrive at EAT. And from EAT, why is it? I didn't touch anything, and it's automatically doing that. And then from EAT, right, by multiplying the dividend payout ratio, you have dividends, right? Whereas free cash flow basically, it has, it comes from, of course, it also comes from EBIT, but then, after subtracting taxes, then you add back depreciation, right? And then investment in operating capital must also come from this operating cash flow. So there's no way we can tell whether free cash flow will always end up greater than it will always be greater than EAT. It will always be greater than net profit, because at least free cash flow will have to provide something to, right? It will have to provide interest, right, to the bondholders. Okay, I'm sorry. This is the bank, so I don't know if the bank is calling. Something's wrong. Yeah, let me put you on. Let me put you on hold for a while. Now they are putting me on the line, so I'll have to. But I can't keep just put you on. I can keep putting you on a hold for long, so I'll just go on.
Currently listening to On Hold Music, another feature that's available for your agents while waiting for calls.
Let me put you on a hold again. All righty. So I don't know if this is a phishing or scam, but they are. It's coming from a very legitimate bank number, phone number, but somehow. Well, okay. So where was I? I was okay.
Yeah, Professor, the bank would normally never call you though.
Yeah, but sometimes there is something called fraud alert, and
Yeah, they would send an email and tell you contact them.
right. So a
Yeah,
lot
it's
of
different. They would send an email and tell you
things.
contact them.
Yeah,
Yeah, be careful with that.
but
Be careful with that, Professor.
Interesting thing is, this is a legit number because it was a number that was registered with this bank, and it's been it's been in use for a long time. So, and I guess somehow the actual bank, has released that number. They're not using that number anymore, but somehow these scammers got hold of that number so that to make it look very legitimate. And so most likely it was I don't really trust it. Everything, even the music and the background noise when you are put on hold, it sounds very legit. But one thing that isn't legit is quite obvious. That I don't have credit card with that bank anymore, right? I haven't used the credit card accounts I had with them were closed long time ago because I didn't use the cards for a long time due to inactivity. It was, and then suddenly they were talking about, some suspicious charge on my credit card. That doesn't, add up. I don't have those credit cards anymore. Why would there be? And even if there's, anyway, but then, the number was legit. It looked it looked legit. Uh, anyway, so here's the thing. Where was I? So free cash flow, we defined it, and then this is actually it's called free cash flow, but actually it is free cash flow to the firm, and that's what we need. Actually, that's what we need. Oh, one more thing. I was talking about free cash flow to the firm. I was talking about why free cash flow is it's bound to be greater than. It's definitely greater than EAT, right? Why? Because EAT belongs to only stockholders, right? This belongs to the stockholders, the owners. Stockholders. But think about it. Free cash flow is like the it belongs to both stockholders and bondholders. In other words, free cash flow is the result of think about it. It's, you didn't pay out interest. There is no interest subtracted from this. So at least that interest is, that belongs to the debt holders, right? Or to the creditors. So in other words, if I can, I don't know if I don't remember if I use these tree analogy. If you think about it, a firm is like a tree, right? And because if you, and this is a fruit tree, and at harvest there will be a lot of fruit, so that's why you have this tree. And this tree, let's say this is $10 million. This tree is $10 million, and then this 10 million was financed by 6 million came from the equity holders, right? 6 million is equity, and 4 million came from debt. Okay, and then so 1 year later at harvest, right? The tree bore a lot of fruit, right? Let's say these are like golden apples or whatever. A lot of fruit, right? So this fruit is the output of the company. And when they, let's say this is, they sold, let's say this is EBIT. The fruits are like EBIT. And let's say it is, 4 million. I mean, 2 million, let's say 3 million. Right? And then think about it. These fruit are the result. These fruits are the results of the 60% contribution from equity. Think about it. These fruits are the result of 60% equity, the workings of equity, which is 60%, and debt, which is 40%. Right? Makes sense. So actually, so there is some portion of this tree that belongs to the debt holders, right? And to debt holders, no matter what it may be, the debt holders, the interest is what belongs to the owners, right? The owners will get paid, no matter the portion of the contribution. I mean, think about it. 60%, all these fruit, $3 million worth of fruit, is thanks to equity and debt, but in by 60% proportion and 40% proportion. Right? You understand that, right? 60%. I mean, these trees, these fruits are, the result of the contribution of equity and the portion of that the contribution is 60%, right? Because that's the capital structure of this company, right? And 40% contribution thanks to debt. So what's the neat way to call this? What's the neat way to say this? 60% thanks to the contribution of the equity, and 40% thanks to the contribution of the debt. But then they don't split this by 60% is, like 3/5, right? 40% is 2/5. But they don't split it like that because fruit belongs to the, eventually, what goes to the debt holders is just the interest. And whatever the interest is, let's say the interest is 1 million, right? So after paying interest, right? And let's say ignore the taxes for now. Then, after paying interest, the total value of these fruits will be 2 million. And then that 2 million belongs to the equity holders, right? Makes sense? 2 million belongs. So that 2 million is then EAT, net profit, right? So if you think about it, free cash flow is slightly like EBIT, but it's greater than, it could be greater than or less than EBIT, because first of all, it will be greater than EBIT because you subtract taxes and then add back depreciation. So I can't quite say it will always be greater than EBIT. I mean, if depreciation is less than taxes, most likely depreciation will be greater than taxes. And then you still have to subtract the investment in operating capital. So it could be greater or most likely smaller because of this, smaller than EBIT. But anyway, free cash flow belongs to both equity holders and debt holders, right? Does that make sense? So with that in, say it again.
Perfect sense, Professor.
Yeah, that's a perfect example. I'm trying to I'm trying to come up with a practical analogy, but then this is a very classic example, but I couldn't think of anything else. So let's go back to our example. So here's an example of free cash flow model. First, the idea is all these free cash flows, right? We will need to discount it to present. If you discount it to present, that's called firm value, value of the company. Yes, what's the value of the company? Now, I've been telling you, value of the company, there are three different valuations, three different values. Three different valuations. One, there's book value, right? Two, there is market value. Three, there is intrinsic value, right? Intrinsic value. And book value is basically, the value by the book. In other words, if you have what is the equity value and debt value on the book? That's called total assets, right? Total asset value. But this is based on the book data, right? But then book value is always past, isn't it right? Because book value is only updated at the end of the quarter, right? After the end of the quarter. So think about it. We are in the middle of the fourth quarter, but until the fourth quarter is over, we don't have the actual fourth quarter data. Now, we have third quarter data, and we're in the middle of the earnings season. I spoke about this before, right? Third quarter ended on September 30th, right? Third quarter ended on September 30th. So we barely have and the earnings data, right? Third quarter earnings data are just coming in. They have just started coming in the fall, and the entire month of fall, all the companies are reporting their earnings of the third quarter. So that's why it's called October is earnings season. Just like that, July, August, September is the third quarter, and then in July, the companies report their second quarter earnings data. So July is also called earnings season, and just like that, April is also earnings season because first quarter earnings report comes in, right? It comes in April. Right? And then January will be also earnings season because they will fourth quarter performance report, earnings report will come out in January of the next year, right? So think about it. Then until January, we don't have any data for the fourth quarter. Until January, the latest data until January, right? The latest data will be end of third quarter data. Isn't that right? Because we are just getting, third quarter data. So during October, November, December, we don't have any concrete data. And of course, the companies will know. I mean, they themselves will know. But at least officially to the public, they don't release the data until until this quarter is over and until the next earnings season, right? So that's why book value is always past. I mean, even in December, right? The most latest data, book data that we have, right, is only as of September 30th, right? Does that make sense? Until then, everything is being speculated. In other words, market value is most of the times market value will deviate from the book value. Market value will be greater than or less than book value, right? Market value will be greater than or less than or equal to the book, but it won't be equal to book value, right? Why? Think about it. Now we have third quarter, earnings data all coming in. And then if the company did well in the third quarter, right, there will be a lot of positive expectations, right? There will be positive or negative expectations. And if the company did well, there will be a lot of positive expectations. Positive expectations will push up the market price because of the positive results. There will be a lot of demand, right? Strong demand. They say Tesla. I mean, they are even Tesla became $2 trillion company just. That was just like a couple of days ago, right? Has anybody read that? Tesla's market capitalization. Tesla's market capitalization exceeded $2 trillion, right? Just a couple of days ago. There has been only two companies. There have been only two companies so far before Tesla. It was Apple and Amazon. Apple and Amazon are $2 trillion companies, meaning their market capitalization is above 2 trillion, right? They reached that point in quite recent years, not that many years ago, around 2018, I believe, around 2018, and then Tesla is the third, and they are now even talking about 3 trillion. Tesla, they are speculating that Tesla had a very good month. Not only good month, I mean entire, because we are talking about quarterly earnings, and the quarterly earnings report just came out, right, in this month of October, and it looks like Tesla did very well. Tesla is now like 1,000 something. Of course, that's nothing compared to where it was in like back in 2019. In 2019, Tesla reached even like 1,600, and then a lot of people did profit taking. In other words, when the price was high, they sold to take the profit, right? They did profit taking. After massive sale, then the price dropped, right? And then so it dropped to like 800, and then they had a split. At some point, they had a split. Around 2020, they had a split, like 2-to-1 split or something like that. So the price went down to somewhere around 400, and then came back up, and so prior to 2018, around early 2018, Tesla was only about $200, and then from 200 all the way to like 1,600 in 2019, and then dropped after profit taking, and from around 800, was it 1,000? I'll have to check, but then they split. The price went down to, but the split is not a negative movement, not a negative price movement. It was just splitting one share into two. So think about it. Why are they talking about like $3 trillion market capitalization for Tesla? It's because of this positive expectation. But I still believe Tesla is overvalued, right? I still believe Tesla is over. Back in 2018, when it was $200, it was still overvalued. But then that gap between the overvalued means the difference between think about it. Then intrinsic value is the value based on the future cash flow. All these, think about it. You learned three different models, right? One is constant dividend, right? Second one is constant growth, right? Constant dividend growth. So dividend at time 1, which is dividend at time 0 plus 1 plus growth rate, right? And then R minus G, which is also called golden growth model. And then variable growth model. It's not easy to put the variable growth model just in single mathematics. I mean, I can do that, but it takes time. And then think about it. What are they all based on? All future cash flow. Isn't that right? It's all based on the future cash flow, right? In other words, all intrinsic values are basically, based on the future cash flows. And so then if the market value can be greater than or less than the intrinsic value, right? And if the market value is greater than the intrinsic value, right, that difference is the basically overvalued portion, right? And so let's say if it is like this, the difference between market value and the intrinsic value, that represents the overvalued right? Overvalued portion of, right, the price. On the other hand, if and it will be positive, right? The difference between the two will be positive. It will be positive, right? It will be greater than 0. But on the other hand, if this is negative, then that's undervalued. Okay. Again, they form positive expectation if there is a lot of good news, right? If the company has good news, doesn't mean noise, but like earnings report. The company made a very good very positive earnings report, right? The company made Tesla's price in the second quarter was somewhere around 800, and then it even fluctuated. Sometimes it went to 500. That's market value, right? But then as of end of September, end of the third quarter, it regained everything, like 900 something. It all came back. So that's why Tesla is now like $1,000, right? Because of the positive the results, right? Positive results. So the point is then value of the firm is, as I said, it can be defined by defined in three ways. First, book value, which is total asset value, right, on the book. Market value is the market capitalization market capitalization of all equity plus market value of the debt, right? Value of the stocks and market value of debt, and which will be clearly different from book value. Intrinsic value is purely based on the future cash flow, right? Future free cash flow. So so the intrinsic value of the firm is then, that's why VC, right? Intrinsic value of the firm is basically, all the discounted value. It's the present value of all the free cash flows, right? That's what this is saying, right? Free cash flow discounted to present, free cash flow discounted to present, and all the way into the infinite future. But again, as I told you, then you might wonder, what is RA? I mean, R must be the discount rate. R must be the discount rate. What does that A mean? A stands for average. Okay, so it's actually a weighted average cost of capital. Okay, weighted average cost of capital. So value of the company, which is the intrinsic value, is the you can say it's the sum of all the free cash flows discounted by weighted average cost of capital, right? Well, time runs from 1 to infinity, okay? And so, what is weighted average cost of capital? Weighted average cost of capital is nothing but, so then where weighted average cost of capital is literally weighted average. And we have two kinds of cost of capital, right? Think about it. Cost of capital, there are two types of capital, equity and debt. Equity and debt, right? So we have cost of equity, which is the required return. And then we have cost of debt. Okay. And remember the fruit, right? The tree is the basically farm. It's the analogy. It's a metaphor for the firm. The tree, because the firm is nothing but a vessel, isn't it right? Firm is a vessel to channel the profit to the owners, right? And as in this example, we assumed 60% of this fruit, 60% of these fruits are thanks to the workings of equity, right? The ratio of contribution of equity is 60%. Ratio of contribution to those fruits of the debt is 40%. So it's a combination. And so 40% and 60% are the weights of the debt and equity. So think about it. It's only fair to reflect that weight. Think about it. This free cash flow belongs to both. This free cash flow belongs to both fund providers. Isn't that right? The free cash flow belongs to both fund providers, right? Both equity holders and debt holders. So you cannot discount it with only required return, right? In other words, what's going on? The required return, cost of equity, which is required return, right? And cost of debt is the bond yield, right? Right? Now think about it. Because free cash flow belongs to both parties or both capital providers, right? You cannot discount it only by either by only this or by only this. Make sense? Everyone. You can't discount it by only required return or by only the yield, right? Bond yield, right? Because it belongs to both capital providers, both types of capital providers. Everyone is clear about that? Any questions so far? No? Okay. I will assume that nobody has any questions. And it's weight. So we'll have to weight average then, and to weight average. So this is weight of equity, weight of debt. We know weight of equity, which is 60%, so 0.6. Oh, give me a break. I'm really dying with this. I have a active, what they call active pen, active touch pen. This is not. I just have the pain with the active touch pen is that you have to have the batteries for it. Bluetooth, because it's Bluetooth. You have, and the batteries that go into that is like quadruple A. Have you ever seen quadruple A batteries? Yeah, they're all quadruple. It's because it goes into the pen. It's a very thin battery, quadruple, thinner than AAA. And then not only that, there will have to be coin cell batteries. You know what coin cell batteries are? The coin cell batteries are what goes into the watch, but it's very big. Actually, it's the size of what goes into the watch is the almost size of a penny, right? But think about it. The pen is very the diameter. The pen is a very thin cylinder, right? Diameter is not even 1/4 of an inch, not even 1/5 of an inch. So two batteries, coin cell batteries that go into that pen is very tiny, and you need two of them. So it's a pain when you don't have those batteries, right? You have to purchase them separately. And then, so until then, I will have to rely on this rubber tip. And then, it's really a pain. So we know the weight of the equity is 0.6, 60%, and weight of the debt is 0.4. That's how you do the weighted average. And so if a required return is 15%, and if the yield on the bond is 8%, 0.08, then 0.15, and that's how you find weighted average cost of capital. Okay, that explains now what this formula, why this formula looks like that, what this formula is about. Oh, not that one, this one, right? So you have to discount it by weighted average cost of capital. So as long as you know this, then it's almost, you're halfway through, because then after that it's pretty much like variable growth model. So let's see. So value of the company is sum of free cash flows, all the free cash flows. And if you have a terminal time, right? If you have a terminal time, and time runs from 1 through terminal time t, but again, this will drop out, right? Unless there is a certain terminal time. Because if it is going to infinity, then it will be close to 0. And then here's an interesting thing. Oh, it looks like there's a excuse me. There's a terminal time. Actually, it is not terminal time, but it's more like a. You see what's going on here? Free cash flow to the firm at time t plus 1 divided by weighted average cost of capital minus G. What's that G? That's the growth rate. And where did we see that before? Where did you see that before? Anyone? Can anyone tell me where you saw that before?
I saw
Anyone
it
tell? What?
I saw it in one of our lessons. I don't remember right now.
Yeah, but the structure of this formula is something.
Was that in the house video, in the home video, in the home slides?
What do you mean by home video? I mean, I use house value example in Finance 100.
No, in the slides for the buying of the purchase of the house.
What?
It's almost the same formula as the PV value. PV.
Say it again.
Present
Come
value.
Again? Yeah. Of course, of course it's present value, right?
Yeah.
Of course, but if it is present value, I mean, where did you see this type of structure before? Where did you see this type of structure before? What's in the numerator is t plus 1, the time t plus 1, right? And what's in the denominator is return, right? Weighted average cost of capital is average return, right? Return minus G, R minus G. So where else did you see this? Oh, come on, guys. Isn't it exactly golden growth model? Isn't it exactly golden growth model? Huh? Look, what? In golden growth model, you're discounting dividend at time t plus 1, right? You're discounting it by R minus G. That's golden growth model, isn't that right? And how do we know what's dividend at time t plus 1? We'll have to, dividend at time t plus 1 is simply this thing is dividend at time t. Oh, give me a break. It's dividend at time t times 1 plus g. Right? That's what this is. That's what I did here. Dividend at time 0 times 1 plus g. It's only, the only difference is that instead of dividend, they only switched it with free cash flow. Isn't that right? They only switched it with instead of dividend, right? They only if I rewrite this, right? Ah, come on. So equal sign, right? Equal sign goes. Right? Plus t, time running from 1 through capital T. And finally, that means at capital T, there is actually value of the firm at time T. Right? It's, you know, in the slide, it's PT, but, you know, we are talking about the value of the firm, value of the company. So value of the firm at time T, right? T plus 1. Discounted by weighted average cost of capital, right? Average, right? RA minus G. Now think about it. Go back to that slide and see what's that slide. Oh, okay. I'm sorry. I kind of didn't consider, you know, time t. So value of the firm at time t, and it will have to be discounted by 1 plus weighted average, discounted back to present, where then, you know, what it's saying is where value of the firm at terminal time is value of the firm at time t plus 1 discounted by weighted average cost of capital minus G. Right? In other words, once we have this, then we can simply, right? Because that's value of the value of the firm at terminal time, capital T. We can simply, you know, plug it in there and find, you know, a present value of the firm at time T. So in other words, remember the previous example we did about the let me bring it up, about variable growth model. This is exactly the extension of that. It's exactly like You remember this, right? In this example, for the next 3 years, right? For the next 3 years, we have dividend forecast. I mean, actually, this forecast is what we generated. We have dividend forecast. Just replace it with free cash flow. Just replace this label with free cash flow. And if we have a forecast of free cash flow for the next 3 years or 5 years, right? And then we can, and since we have, weighted average cost of capital, we can discount it to present. And then after the next 3 years, then free cash flow will grow at a constant rate. Look, if anything is growing at a constant rate, then it's golden growth model. Then we can generate, we can forecast what's going to be the free cash flow at time t plus 1. And using that, we can, using the growth rate and the weighted average cost of capital and growth rate, we can discount it to 1 year back, which is time t, and then so that is the value of the firm as of time t, and then time t is not capital T, time capital T, value of the firm at time capital T. That's not present. So present is like 3 years back. So we discount this by 3 years, right? Everything is pretty much the same, except that this is not just the required cost of equity. This is, weighted average cost of capital. So it may not, okay, for you, this may still, no matter what I say, it may not ring any bell that much. So let's do the example. Let's go into the example. So the example is, I mean, there are more advanced example, but let's look into the basic example. So Dewhurst Inc. data for free cash flow valuation model. So we already have a forecast, right? For the next 5 years, 1, 2, 3, 4, 5, the free cash flow forecast is like this. Okay, and the growth beyond 2017, growth will be like this until 2017. Growth beyond 2017 will be 3%. That means, growth of the free cash flow. That means it's going to be a constant 3%, right? Weighted average cost of capital is 9%. Okay? So 2017 is like capital T. I wish I could. The problem is this is not. You cannot draw on this. I mean, it doesn't allow. You can't. There's no draw, right? You can't draw on Adobe. Let me. Okay, let's see if I can copy this. Let's copy. And can I put it in here? Let's see. Can I paste it here? No, I don't think I can. Oh, insert, maybe I can. Paste. Oh, okay. All righty. All right. At least, being able to do this is good. Yeah. What? So think about it. This is time terminal t, right? You understand? And then beyond, so beyond after 2007, right? Um, the growth rate to infinity is 3%. So it's constant growth. So what does that mean? Use Gordon growth model for value of the firm at time t, as of the end of time t, right? Come on, then it's the Gordon growth model, right? We can generate forecast because growth rate is given, and then weighted average cost of capital minus G, growth rate is given there. Weighted average cost of capital is 9%. So we can do this. Then what are these? Look, then that's something we will need later. But given this data, right? Let's think about how we can approach this. So it's 7:09. I think it is a very good time to take a break. During the break, please, read this. I mean, the slide is here, right? And I have explained everything here. Please study that, and then think about that, right? I will. So we will. It's 7:10. So we'll reconvene at 7:20. Okay, reconvene at 7:20. All right, and think about it during the break. All right, we're back. We're back. So let's go to the yeah, not this one. Let's go directly to the Excel model I built. All right. So first of all, for the next 5 years, right? We have free cash flow forecast already generated. So actually, in the if you remember, in the variable growth model, there was a growth rate. There was a growth rate given. So we could use the growth rate to generate the forecast of the dividends in the following years. But here in this example, they were given, so it's better. It's better. It's easier. We don't have to generate any forecast. So all we need to do is then we'll need to find the present value of these numbers, right? These free cash flows. So using the weighted average cost of capital, they already gave. Here's another thing. Usually, in a more complex problem, they won't give you weighted average cost of capital. They will make you calculate it. So then, there will be the weight. You'll have to look into the capital structure, and from the capital structure, you'll have to figure out what is the weight of equity, what is the weight of debt, and then you'll have to also calculate the cost of equity and cost of debt, right? But in this problem, weighted average cost of capital is already given, so it makes our lives easier. It's 9%. So the present value of the cash flows is simply discounted by, see, this weighted average cost of capital will have to be locked. Of course, it will have to be locked. So I locked it, and then that will be raised to this time digit or year digit, right? Years digit. And then you drag it down, and you'll have, right, present value of all those free cash flows. You might wonder, what is column F4? I mean, isn't it the same number? Yes, it's the same number. It's the same number. But why did I duplicate it there? It's because I duplicated it just for the last year 5, right? Because year 5 is time t, right? This is time capital T, right? Oh, come on, what's... Got stuck. Oh, don't do that. And in time capital, in year 5 or time capital T, we have not only this one, but also we'll have the ER5 value of this. So in other words, for ER6, which is 2018, as I said, this time we'll be using where's the pen? Well, I wish I could be. I need some air. So think about it. From ear t plus n, right? From ear t plus n, t plus 1. What happened? From ear t plus 1 is going to grow at a constant growth rate of 3%. Constant growth rate of 3%. So we need to use the golden growth model. So to use the golden growth model, you have to generate the forecast of free cash flow at time t plus 1. And of course, here it is. We have free cash flow of time t, right? Capital T. And then by compounding it, by multiplying it by 1 plus this growth rate, we can generate forecast of free cash flow of time t plus 1, right? We all know that this is, even if I don't write it like this, you should know, right? Because what else can it be? What else can it be? You follow this, the label is FCF. So this must be FCF. FCF of what? Year 6, right? And year 6 is, since year 5 is time t, year 6 is t plus 1. So that's FCF of t plus 1. And then we'll, using, golden growth model, the value of all the free cash flow, value of all the free cash flow as of so this is like okay, maybe V would be better. Value of the all the free cash flows as of time t, right? Which is right? And that's I found it by Golden Growth Model, right? C48 is basically this, right? And then E41 is the weighted average cost of capital minus growth rate, right? E48. And then that's the value of the firm, which is the value of all the total cash flow as of the end of 2017. In other words, as of time t. Therefore, this gets added to this, right? That's why I had another column. I mean, you don't have to do it necessarily like this, but this is how I did it, because this is a cash flow, right? Value of the cash flow at the end of 2017. So they must be added, right? They must be added. They must be added, right? So then all we need is find the present value of all of this. And we have already, we know how to find present value. Just discount it back to time 0, which is in this example, 2012. And so if you drag it down, come on. So then you drag it down all the way down. We got all of the present values. And finally, you just sum it, right? Sum everything. Then you come to, this is the result, and this is actually value of the firm at time, value of the company at time 0. This is the value of the company at time 0. Okay, so here, value of the company at time 0, right? So it's pointing to, I made it equal to this. Now then the next question is, it was already in the slide, but the we all understand that the value of the company is sum of, right? Sum of all of these things. Value of equity plus value of the debt. We have one more thing. Value of the preferred stock plus value of the debt. Normally, think about it. When we say stock, we don't so far we didn't distinguish between common stock and preferred stock, but the stocks fall into two categories. I already talked about the preferred stock. We all know. I mean, it's nothing new. So the market value of the preferred stock is given. I mean, they gave. This is a very kind example. I mean, easy and kind. They provided everything. But again, in a more complex example, it's not that easy. And you have to calculate all of them. So we have value of the common stock. I mean, we don't have it yet, but we have the value of the, so we don't have it yet. We have value of the preferred stock. We have value of debt, right? So in other words, value of the company is the sum of all of these things, right? sum of all of these things. And this is known, right? Value of the company is known, right? We just found it, all right? Value of the company is this, right? We just found it. And value of the common stock is known. Value of the preferred stock is known. Value of the debt is also known. It's all given. And this is what we don't know. Of course, what is this? What is this all about? The free cash flow model, all these models were valuation models of equity, common stock, right? It's the valuation model of common stock. So, and as I said, free cash flow model is used when dividend data is not available. So we cannot use dividend discount model. So we had to approach it in an aggregate way, because all of these numbers are aggregate numbers, right? In other words, value of preferred stock, value of the company is the aggregate number, aggregate, and value of the preferred stock is aggregate number. Value of debt is also aggregate number. And since we don't, stock price is what we want to know. Since the stock price is what we want to know, and when we say stock price, that means per share value, right? Always, stock price means per share value, right? So first thing is, now we can isolate, we can find the value of the common stock. That's totality, right? Aggregate, totality. The totality of the value of the common stock. And it's not market value, it's intrinsic value, right? It's not market value, it's not book value, it's intrinsic value. But then, you might wonder, they all say this is the market value of the debt, market value of the preferred stock. So isn't this the market value? Isn't this the market value of the company? And then isn't this the market value of the equity? Yes and no. But in this model, it is yes. Why? This is an equilibrium. We are assuming equilibrium. And I told you, at equilibrium, market value would be equal to intrinsic value, right? In equilibrium, everything will be, market value will be equal to intrinsic value, which will be equal to book value. Everything will be, in equilibrium. It will be in perfect harmony, right? Everything will be elegantly corroborating each other, right? In equilibrium. But again, equilibrium is an ideal situation, and it happens rarely, and even if it happens, it's fleeting. It doesn't last long, right? It's very transitory. It's fleeting rather than transitory. Fleeting. But we know what to do already. When everything else is known, and this one is the value of equity is the only thing unknown. What do? You'll have to subtract from value of the company, right, the sum of the value of the preferred stock and value of the debt, right? So that's what I did here. From the value of the company, I subtracted, and there's value of debt, value of preferred stock, all given. So value of the common stock, right? Or maybe I should have, right? Maybe I should have done value of equity. Maybe uppercase. Value of equity. So this is the total intrinsic value of the total equity, right? Yeah, which is just this. This is the value of the total equity. And then there are per share value is then maybe, this is not. Value of the stock at time 0, right? Subscript. So then value per share, right? Value per share, value at time 0 per share is simply this divided by number of shares. So there you go. We arrived at, finally, this way we arrived at, right? Value of the stock, common stock, value of the common stock, when there is no dividend, right? Using only free cash flow. It's not only using free cash flow, a lot of other things were used. But we got it. We got there, right? And finally came to the, okay. So this is a simple example of a simple problem, right? Simple example of free cash flow model. There's a more complex model, right? It's just, I did the complex model in the main lecture video. In the main lecture video, I did the complex model, right? This is the complex model. And I did it in the main lecture. So please, the main lecture is already over. I mean, actually, as of today, let's see. Oh, come on. I'm even logged out. It's a good thing you guys are there and you can hear me, right? I'm logged out. So when I'm logged out, I think Collaborate is also, I'm automatically logged out of Collaborate. That's what I think, but I'm still here, and looks like I'm not cut off, but I was logged out from the Blackboard. But it's a good thing. The connection with the Collaborate wasn't cut off. Isn't that right? You guys can't hear me. I mean, all this time, it wasn't.
Yeah, I can hear you.
Okay, great. It wasn't. So what I wanted to tell you was, by the main lecture, actually we are done with the convexity. We're done with the bond portfolio management, right? Actually, today we are already into topic 4. Oh, we're already into a lot of it. But topic 3 is already over, right? You cannot even, so that was more than 1 week ago. So it was available until yesterday, I believe. And that's why, because we have covered topic 3, right? That's why you are, you're supposed to have everybody, you're aware that midterm 2, right, is starting tomorrow, right? Midterm 2 is starting tomorrow. I didn't get a chance to talk about this, but if you're interested in, now here's the thing. If you're interested in this, please let me know. I will, I'll be happy to provide more information. Okay. Okay. I was just about to continue with. So we have, as I said, we have 2 categories of free cash flow. One is free cash flow to the firm, and that's what we have done. That's what we have used. And then we have free cash flow to the equity holders. And think about it. Some of the free cash flow belongs to the debt holders. Why? Interest, right? Interest payment belongs to the debt holders, right? So we'll have to subtract it. But then you might wonder, what is times 1 minus this? That's tax rate, corporate tax rate, right? That's Greek character tau. Greek character tau is Roman T. So what would that be? What would that mean? That would mean, of course, just tax rate. And think about it. Interest. There's a tax shelter. You don't pay all of the. You don't pay all of that as interest. You don't pay all of the interest. You pay only 1 minus tax rate, right? If the tax rate is 30%, only 70% of the interest is paid. Why? Because interest is business expense, right? You have so only 1 minus tax rate, interest payment times 1 minus tax rate will belong to the will go to the lenders or creditors or debt holders, and the change in net debt, if it's cash flow from sale of new bond, right? Or think about it. If you sold new bonds, there is cash inflow, but you have to make principal payment. I mean, the debts, bonds that are retired, you have to pay off the principal. So the change in net debt will be added to the free cash flow to the firm. Think about it. What that means is, suppose the company sold a bond. I don't know what this is. Why is it? $10 million, right? And it's, let's say, 10-year bond, right? So this is the face value of the, I shouldn't call it face value because face value is always 1,000. That's the principal, right? Redemption value, or principal or redemption value. So I should call it principal, right? Maturity, 10 years, right? So until then, you pay only the interest, right? That's how the bonds are. You pay interest until this time, and at year 10, then you'll have to cough up 10 million. You'll have to pay the last year, year 10 interest at year 10 plus the principal of 10 million, right? Right at time t. And for the 10 years, paying interest wasn't that big of a deal. But then, suddenly you have to come up with 10 million. But so does the company actually cough up 10 million? No. And I've been telling you this. Company doesn't. They simply roll it over. They simply refinance it, refund it. In other words, before year 10, before they sell new bonds, new round of bonds, new round or new batch of bonds for 10 million, right? Then what happens? Then, we have the cash inflow at year 10. There's cash inflow of 10 million. From sale of new bonds, right? And then this will be used to pay out, this 10 million will be used to pay out, come on, don't give me this. And this 10 million will be used, right, to pay out the principal, right, to pay principal. And if you sold more than 10 million in the new sale of bonds, right, let's say you did, 20 million, you sold, 20 million. You sold 20 million. Then 10 million out of that 20 million will be paid out to the existing bondholders, right? Then remaining 10 million will be, that becomes exactly that becomes exactly change in net debt, right? But it's cash flow, right? That 10 million is cash flow, cash inflow, net cash flow, right? So then that is, of course, the change won't be, that drastic. It could be just, some amount, small amount. But then that will be the free cash flow to the equity holders. So it's an alternate method when there can be an alternate method when number of shares are unknown, right? There can be alternate method when number of shares are unknown, because and also a market value is equal to intrinsic value in equilibrium, and which doesn't happen in the short run, right? So in that case, if we use, think about it, if we use free cash flow to the equity holders, then we only need to discount it by cost of equity. We don't need weighted average cost of capital, right? Makes sense. So if that is the case, when number of shares are unknown, right? We can even do that when value of debt and value of preferred stock are unknown, because it's totally value. It's free cash flow to the equity holders. So all of this is purely, right, the value of equity, right? It's all okay. Alrighty, so that is a free cash flow model, and then the complex model, I did it in the main lecture. So please go to the main lecture, and they talk about the some problems of the discounted cash flow model, the pros and cons, and the cons, right? Its problems, so its cons. Model values differ in practice because it all depends on why? Because it all depends on what kind of discount rate you use and what kind of forecast you use, right? Even the growth rate forecast may vary, and we use too many simplifying assumptions. So depending on how many simplifying assumptions we use, depending on the varying degrees of simplifying assumptions, right? We can have different results. So investors need something. They want to know. They want to have something concrete. So they have a hierarchy of valuation. First of all, fixed assets like real estate, plant, equipment, that's the most reliable components that allow for a reasonable estimate of the market price. And an economic profit on assets in place, that's less reliable than real estate. Growth, and I talked about this, present value of growth opportunities. It's the least reliable component, and it's the most speculative component, right? In the last class, I spent, or probably in the one before the last, we spent, a fair amount of time, right? We dedicated so much time to present value of growth opportunities and why it could be nothing but a bubble, right? And I introduced, price earnings growth ratio, right, as a tool to vet, right, as a tool to vet the P ratio, right? Remember, price earnings growth ratio, which is price earnings ratio over earnings growth ratio, earnings growth, right? This is price earnings growth And if this ratio is close to 1, the price earnings ratio is justified. Okay. Uh, and there's still so much, yeah. Again, that brings us to the discussion of growth opportunities, right? P ratio is opportunity. So I think this is it's 8:02. I think it's a good time. We are until 8:30, 8:45, right? 8:45. I thought it was 8:45. So I think this is a good time to take a break. And I'm having a little like a pressure in my chest. So I think this is a good time to take a break. So let's take a 10-minute break and reconvene at 8:12. Okay. All right, we're back. We're back. So, yeah, let's think about the P ratio, and this is a recurring theme. P ratio is a very popular measure of valuation, right? And the reason I'm going to talk about why. So here, so P ratio and growth opportunities. P ratio is also called P multiple because it's price over earnings per share. It's the ratio of stock's price to earnings, right? So we know and I'm gonna first of all, I'm gonna tell you why price earnings ratio is a very before the days of dividend discount model, right? And the dividend discount model actually came out around 1950s. I mean, prior to 1950s. Prior to 1950s, they didn't have discounted cash flow model. In other words, all these, discounted cash flow model and dividend discount model is a subcategory of discounted cash flow model. Even think about it. Even free cash flow model is also a kind of discounted cash flow model. So you can say discounted cash flow model breaks into or splits into a dividend discount model and free cash flow model. All right. But then that they all came around, in 1950s. Then prior to 1950s, how did they value the stock? They used, P ratio. So the idea is like this. But we know very well that P ratio is the reciprocal of earnings yield, right? Which is, right, earnings price ratio, raised to -1 because it's the inverse. But then, if you think about it, the earnings per share that we use for for that is earnings per share at time 1 or price at time 0. Why? Because when you buy the stock, you buy the stock at time 0. And when you buy the stock at time 0, you can't get the earnings. Isn't that right? Huh? When you don't have earnings when you buy the stock. You will have the earnings only after you buy the stock. In other words, you will have earnings per share at time 1, but for that you had to pay P0, price at time 0. Right? Everyone follows? Does everyone understand? right? So actually, earnings yield, we have two different times, right? In earnings yield, there are two different times. Earnings per share is at time one. That's the earnings per share is earnings per share at time one. Price is price at time zero. But usually, price earnings ratio is sort of like average number. They use, average earnings per share, average price. So it's not exactly, you cannot say that it's exactly the reciprocal of this. You cannot exactly. But question is, how do you find price in the days prior to 19? How do they calculate the? How do they value the stock prior to 1950s? What they did was, think about it. If you multiply price earnings ratio by earnings per share, what's going to happen? If you multiply price earnings ratio by earnings per share, what should happen? Can anybody tell me? If this earnings per share is the same thing as this is what? This is earnings per share too, isn't that right? Anybody listening? Huh? Think about it. This is earnings per share. Isn't that right? So if this is earnings per share, this is earnings per share, then what's going to happen? What should happen? They should cancel out, and it just becomes P. In other words, then what? This is what? This is market price. Market price. So then this is simply coming back to itself, right? It's like, this is a stupid thing if you think about it. I mean, I cannot put it in any other way. You multiplied earnings per share by price earnings ratio, but by definition, price earnings ratio is market price over earnings per share. So the earnings per share, the EPS and EPS will have to cancel out. Then it just comes back to market price. And how can you find where is the valuation? I mean, this is not the value of the stock. In other words, intrinsic value of the stock. This is not the intrinsic value of the stock, right? It cannot be the same thing. I mean, market value is not the intrinsic value of the stock. They can be the same thing. Market value is market value can be the intrinsic value only at equilibrium, but otherwise they cannot be the same thing. But then, if they say prior to 1950s, they use this, and if they use this, then it's not valuation because it's just taking you back to the market price. Right? So that looks like a futile, a very stupid thing, because after all that, if it is just taking you back to market price, what's the point of that? So here's the thing. It's not really the so actually the price earnings ratio they use here is not the price earnings ratio of that company, right? The price earnings ratio they use here is the industry average, right? Industry average price earnings ratio. And then earnings per share here is for that particular company, earnings per share of the company X. So then think about it. Company X, the market price of the company X may be something, right? But that doesn't matter. We don't care. We're not interested in the market price of that stock because market price is something, you can always look up. I mean, that's not the intrinsic value. That's not what we are looking for. We are looking for is the intrinsic value of stock X. And intrinsic value of the stock X can be estimated. In other words, it's only an estimate. In other words, it's not a it's not the rational or it's not the precise number, but just an estimate. Why? So think about it. When you use average, industry average, right? Price earnings ratio of the industry, right? Average, right? So that's price industry average. And if the industry average is like, 15, okay? Let's say 20. It's better to use the round number. If the industry average is 20, then multiplying this firm's price earnings per share. If the earnings per share is $3, then wouldn't this give like $60, right? And then market price could be 70, or market price could be whatever 80 or 75. But if the if this is the intrinsic value, this is what is deemed intrinsic value, then you can say the market is overvaluing or overpricing this stock. But the reason we consider this as the fair value or rational value or intrinsic value is because on average, in this industry, on average, price earnings ratio is 20. So through the industry's lens, through the lens of this industry, since the industry average price earnings ratio is 20, if the earnings per share of this company is 3, right? Wouldn't it be reasonable? Wouldn't it be reasonable to expect $60 for price? Right? Wouldn't it be reasonable to expect $60 for price? That is the rationale behind it. That's the rationale behind it. Rationale. That's the rationale behind it. So obviously, this is far lacking. This is very much lacking, right? It's only a rule of thumb, nothing but a rule of thumb. There must be something better. That's why the discounted cash flow model came about. Okay, that's what they call price earnings multiple, and that's how they used it, right, for valuing stocks in the old days. Now, then this is back to so what is the determinant of the price earnings ratio? Of course, It's the market price and earnings per share at time one. And we all know the math looks a bit complicated, but it's nothing. It's nothing new. It's basically the math to explain present value of growth opportunity. Let's not. So this is. I'm not going to go over this again. This is we spent a lot of time. This is just a more theoretical explanation of the connection between price earnings ratio and present value of growth opportunity. Okay, so I've been switching the symbols, here and there. The thing is, for this is always the market price, right? And then intrinsic value is, the symbol for intrinsic value is this. But sometimes I used also this stock price, right? So clearly, these two things are clearly different things, right? Sometimes I use V0 or S0 for intrinsic value. The reason I used S0 was V0 looks like, aggregate. It looks like aggregate value, like, total value of equity. Aggregate. It kind of looks like aggregate value. So just to make it clear that this is a per share, right? Per share value. I use the sometimes S for stock price, intrinsic value of stock price. I don't know what that red eye is. That means something's not right with the with the whiteboard. So as you go through this slide, you will see you can simply consider, oh, that means intrinsic value, right? And I'm not gonna go over this again. The point is, I already explained this. There are two camps in the in finance. High price earnings ratio camp and low price earnings ratio camp, right? The camp that champions high price earnings ratio and versus the camp that champions low price earnings ratio. Because, as I said, and I did, this discussion was done before, so I don't want to go over that again. And the camp that the proponents, in other words, the proponents of high price earnings ratio are the high price earnings ratio, and the proponents of the low price earnings ratio, low price earnings. And Warren Buffett is a typical champion of low price earnings ratio. But then the other camp, and it's obvious, I mean, low price earnings ratio means, more earnings per share for the price. Isn't that right? But then the camp that's, the proponents of the high price earnings ratio is always saying high price earnings ratio represents present value of growth opportunity. Again, this is, as I before, this is a BS right? I'm not saying, it's totally unfounded, but the reason I'm saying it is a BS is that it can go it can go either way. I mean, it can take off or it can flop. If it flops, it's all bubble. It's because it's all speculative bubble, and they just call the bubble a growth opportunity. If it takes off, and Tesla is a good example. I should say Tesla is a good example of bubble, but still, going strong. Full of bubble, but it going strong. Uh, Actually, but Tesla still makes something. Tesla is, although the earnings per share may not justify. Oh, who knows? In the past, earnings of Tesla didn't justify the price. Um, Even now, I guess they have good earnings, but still the price is beyond justification. But again, I told you uh, there is a way to check. It's PEG ratio, and if PEG ratio is close to 1, that high price earnings ratio is justified, right? I haven't checked the price earnings ratio of Tesla, but I will see, because they will have its earnings season. Tesla's earnings report came out, so if you and then using the also to calculate earnings growth ratio, you need the data from the past, right? So I can calculate the earnings growth rate from the past to present, right? Using the data from past to present, and then we'll see if price earnings ratio is justified by PEG ratio. Um, and the PEG ratio is unsustainable, right? So, for example, Bitcoin. Does Bitcoin have any earnings? Huh? Does Bitcoin has any earnings? Bitcoin doesn't make anything, right? It's just so there can be capital gains, capital loss in Bitcoin, but using capital gains as maybe you can think of capital gains as earnings, but that's not really that's not really earnings. It's just capital gains. Um, so, but even if I substitute the capital gains for earnings with earnings, uh, the PEG ratio would not be close to 1. Clearly, Bitcoin is Bitcoin's high price earnings ratio. I mean, first of all, can there be price earnings ratio for Bitcoin? Technically, there's no price earnings ratio for Bitcoin, because it's not making Bitcoin is not a company. It's not making anything, right? But even if I use capital gains as earnings, uh, I don't think this ratio. So it's even the high price earnings ratio of Tesla is not cannot be not Tesla, Bitcoin. there's no even price earnings ratio. I mean, it cannot be. But even if you arbitrarily do that, right? Arbitrarily calculate it, then you won't see anything like this PEG ratio of close to 1. You won't see. Okay, that's well, that that wraps up our discussion of today. Let me just, this is a quite interesting study. So they compare the companies given the required return of, right, cost of equity, or the return, right, required return of 12%. Companies that have with different plowback ratio. Now, plowback ratio of 0, that means, paying out all the earnings as dividends, right? 0.25, 0.5, 0.75. And then we know growth rate is, so this is the growth rate. These are the growth rates. The growth rate is the ROE times plowback ratio. We know that. So ROE times this, as this, ROE times this, 2.5, ROE times this, 5.0, and so on, right? If the return on equity is 12%, 14%, under different plowback ratios, we have these, right? These growth rates. And then think about it. Growth rate is supposed to be less than the required return, right? Why? Remember, simply mathematically, right? Our required return in golden growth model, right? R minus G, right? So think about it. There is no way this can be like this, right? Then think about it. Then, this will be negative then, right? If this is like this, it will be negative. Investors want a higher return than the growth rate of the dividend, right? And there's no way, this can be less than 0, negative. If this is negative, then this will have to be negative too, right? That's ridiculous, right? That doesn't, mathematically, it's not even a remote possibility. But then also, let's think about the P ratio when so this equal sign is, don't get this equal sign wrong, right? The equal sign here, right? The equal sign, that doesn't mean that's K. It means, G, right? It's G, but, that G is less than K. So then let's take a look at the P ratio when, and this is kind of justifying high P ratio, when high P ratio will result when a lot of the earnings is plowed back. In other words, look at 75% plowback ratio, right? If they the growth rate will be like this. Growth rate is high, so then look, as the growth rate is high, right? You see, I'm pointing at, you see this because I'm pointing at this number with high ROE and a high plowback ratio. The P ratio will have to be the highest, right? With the highest ROE, with the highest plowback ratio, right? With the highest plowback ratio, right? Here, 10 point, that's growth rate. Highest plowback ratio of 75%, right? The growth, the P ratio will have to be the highest, right? So this is one way they justify that the high P ratio is the result of high growth rate, right? ROE is 14% and 75% plowback ratio, right? The growth rate is the highest, and with the highest growth rate, highest P ratio. So in a way, they are the authors of this textbook are proponents of high P ratio, right? And they are justifying the present value of growth opportunity because they are justifying high price earnings ratio with high plowback ratio and high growth rate, right? High growth rate will, what they are saying is from this study, from the result of this experiment, they are saying high growth rate will result in high price earnings ratio. Okay, that's what it is saying. All right, so I think that we will have to call it a day here or call it a night. We are, we're still, have some slides left, but, they are just, some, empirical studies. And of course, but it will be interesting to do some of these, examples. And we're going to do that. Of course, we'll have to do it next time. We can't do it this time. So any questions so far? Any questions?
Well, Professor, so the midterms tomorrow, right?
Yeah, you have 3-day window. 3-day window.
Okay.
And like 120 minutes or 180 minutes, but you will see it, when it opens up. Okay. All righty. If there are no further questions, all righty, you two have a great evening and good luck with your midterm too. And I will see you guys next Thursday. Okay. Take care, everyone. I'm